For more on the U.S. economy, we welcome back Thomas Hayes joining us. He's the founder, chairman, managing member of Great Hill Capital. Good to see you. And, you know, I'll start with this. The markets and the economy is like sports. Just when you think, like, you got to figure it out, it's got you. You know, just run the ball. We thought the market was going to crash this morning at the open, and then we had this most ridiculous rally. And I've heard all the reasons, the technical aspects. Maybe it's so bad that it's good.
Well, Phil, thanks for having me. It's kind of like we ran out of sellers. You know, the morning started open. The futures were up on the UK walkback of the tax policy. Then the CPI hit. We sold down into the opening. But the market rebounded midday, and very few people are talking about this. There was a Reuters article exclusive that the ECB terminal rate, there was a staff note that the terminal rate could be 225. And what you're seeing across the board is that central banks are getting disciplined by the credit markets. We saw it with Bank of England having to buy gilts. We saw it with the ECB having to buy Italian bonds and now walking back their rate hikes. And then the RBA in Australia hiking less than expected. And I think that, you know, people are coming to the conclusion that we're going to just have to live with a little bit of above trend inflation. We increased the money supply materially, $5 trillion some odd dollars in 2020. It worked on a lagged basis, year and a half, 18 months to see the inflation. And we only started tightening in March. It's going to take 6, 12, 18 months for that to start to be reflected in the numbers, particularly the way some of those statistics are calculated, like owner's equivalent rent, which actually skewed the numbers today. If you look at the way housing prices have been dropping, the owner's equivalent rent, the housing component, which makes up 50% of the weighting, should have actually been negative 0.7%, not positive 0.7%, which would have wiped out all of inflation. But that's not going to show up for 6 to 9 months the way that it's calculated, and that's misleading. And if Powell waits, just like he waited to see inflation before he started hiking, even though all the indicators were that it's coming, if he waits to see 2% and keeps hiking until he sees 2%, he's going to overshoot on the downside and drive the economy off.
Right. So what you're saying is that when we look at these numbers and other central banks are doing it, the Fed hasn't hinted at it. I'm sure they don't want to hint at it. But what you're saying is that they're rather have inflation be medium high, but you don't want to keep raising rates. And what does that mean for November? Does that mean do you think another 75 basis points?
You know, if they follow the path that they've been doing, which is overdoing it, they'll do 75. I think the sensible thing to do is to do 50 and wait and acknowledge that there's the difference between supply-driven inflation and demand-driven inflation. The 70s was demand-driven inflation. This is supply-driven inflation, and it's going to take some time to work through the system. The other thing is Jay Powell has this fantasy that he wants to be Paul Volcker. The problem with that is when Paul Volcker was raising rates, our debt to GDP was 30%. Today, it's 122%. Every 1% they hike the Fed funds rate adds $285 billion to the annual deficit. With what they've done already, they've added about $1 trillion a year of expense moving forward, which is approaching the line item of Social Security. So they can't have it both ways. I think what they're doing is correct. Talk very hawkish to anchor long-term inflation expectations. 5-year break-evens are 232, down from 359 in March.
Right.
That's a good thing. But ease off on the action or you're going to drive the economy off a cliff.
So they should talk hawkish, and Thomas and Phillip will just be really skeptical of whatever they say, and we'll continue this part. Let's talk about jobs, because that's one of the reasons why Powell and a lot of folks believe that they need to slow the economy down, because the job market was really hot. But at the same time, there's sort of conflicting reports, right? You're coming out of COVID. And by the way, there's this new variant I just read about, apparently, that's just starting up once again. And then you have this group that has long COVID in America. There's one report that says, I think somewhere around 4 million people have long COVID, so they're essentially taken out of the workforce. Now, from an economic perspective, if they're taken out of the workforce, then that's less people to work and fill those positions that you need in the service sector.
Yeah, there's no question. I mean, we did see the JOLTS report that came in a little bit light, so there were less jobs available. So that's a good sign from Jay Powell's standpoint. I don't see how it's a good thing. I think for the most part, people would rather pay 25 or 50 cents more for a gallon of milk and keep their job than have Jay Powell put them out of work because he made a mistake last year. And I think that's what they need to be really careful of moving forward. And if you look back, Phil, it's actually a decent plan to run inflation above trend for 3 to 5 years. They did it from 1948 to 1953, post-World War II. They took debt to GDP down from 120% to 63% in 5 years through inflating it away. That's the plan government's been using for hundreds of years. And I think that playbook will work this time. And by that time, we can work through the supply-based inflation and let the impact of housing prices come down, commodities prices come down, work through the system, and keep everyone that wants a job employed. Prices will be a little bit higher. Wages will go up modestly. Talk hawkish. Keep long-term expectations pinned, and everything can be okay.
What's the black swan event that we're worried about between now and the end of the year?
I think it's a white swan, and I think the white swan is managers were positioned for the Armageddon, and it actually rallied on bad news this morning. Expectations going into earnings for Q3 are so low right now. The bar is so low, just like it was going into Q2 in June, and that enables us to beat expectations. And I think the biggest fear for managers is that this market's going to run away from them and it's going to move higher into year end, and they're all in too much cash. Highest cash levels since the lows of the great financial crisis, highest cash levels of the pandemic lows, and the trouble was already in the rearview mirror. The market's a discounting mechanism, and at 25% down, the S&P did, it priced in a lot of bad news. And I think that we're going to find in earnings season that earnings are holding up relatively much better than analysts expect.
All right, Thomas, next time we need some stock picks from you. Let's go make some money. I guess things maybe aren't that bad. Thank you very much.